Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, Appreciating Line of Credit, part 5 in our series on home equity solutions in retirement with financial advisor Eric Brasch. Welcome to the show, Eric.
Thank you, it's great to be here.
And also Eric is a mortgage analyst.
That's correct.
As well. So, and I like the combination because you're kind of best of both worlds here. We're talking about something that seems to me, at first blush, it just seemed to be ridiculous. I said it can't be. Appreciating line of credit. Let's do the traditional one first, a regular HELOC loan. If I have a regular home today, I can go get a HELOC equity loan. It's an equity line, but I got to pay my annual interest.
You're going to pay the interest on it.
And
you also have to qualify on it on several ways. You have to qualify on debt ratio, and you also have to make sure that the home has enough value. Since 2008 and the mortgage collapse, they've pulled back a lot of their guidelines. They've tightened up their guidelines where you used to be able to get 100% of the value of your home in the form of a second home equity line of conversion or the home equity line. You can't do that anymore. So you're leaving some equity on the table because they're just not safe.
They want a little bit of room here.
Exactly. But it's just about enough room to sell the house.
Okay. I have to pay interest though.
Yes, you do.
And usually those notes are what, 10 years long?
Typically they're 10. Most times, if you have it past that, you're paying more in the interest. There are 30-year HELOCs, but you pay a little more in the interest as an additional option.
I don't know if I'd want to tie it up that long. But here's my real thing. On a HELOC loan, a traditional loan, if the market value of the home decreases, they could call the note. It's not just freeze that they could freeze, but they could also call the note.
They could. If the deterioration is to such an extent where they are left in a negative position, they could call the note due, which would force you to do a refinance and or sell the home.
Now, that's the traditional HELOC loan that we're all used to. But if you're 62 and it's your prime residence, tell me about the HECM, or Home Equity Conversion Mortgage Appreciating Line of Credit.
So the appreciating line of credit is appreciating on 6.1% per year.
Unreal.
Regardless of anything else that happens. It's always there.
But that's this year. Could be a different rate next year.
Could be next year. Could be different rate. They change it periodically. It could be higher or lower. We don't know. But it doesn't have anything to do with the value of your home. Once you start this thing, it appreciates, and as you see the amortization schedule of it, you will see the appreciation. So the longer you let it sit without doing anything, the more it will be worth.
So the line is increasing every year at 6.1, the unused portion.
Correct, the unused portion.
The unused portion, okay. So I'm thinking, and this is just Steve talking out loud. This is why I bring these things up. 6.1%. Steve, can I go out to the market and get me 6.1% without any beta risk? Answer, no.
Nothing. Correct.
Can I get Social Security at 8% simple, which is, I think, something around 5.25 compounded from age 66 to age 70? Remember, we talked about this delayed tactic in the first segment. No.
Correct.
Without risk, none. So when I'm looking at 6.1% on this appreciating line, this is a huge deal and not correlated to the market value of the home.
That's correct. And the design of it is, and this is a design and a model that they've created in recent years due to the fact that so many baby boomers, which is what this product was designed for, are having to spend excess amount of money in health care and or stay at long-term care facilities and or assisted living.
Well, let's go down that road. I mean, there's people here that say, Steve, I went out, I sat down with my advisor, I looked at the long-term care. I wish I could get it, but, Steve, I didn't get it. And, I waited till I was into my 50s, and it's not cheap. And I looked at the hybrid products. Some of them look like they could work. It has a long-term care rider with maybe an annuity product or a long-term care rider with a life insurance product. But a lot of people say, I just don't see the math on some of those products. It didn't work for me. So I've been sharing with people, maybe the appreciating line of credit should be your ultimate long-term care backstop. If you're like me and you're a boomer, I do not want to go to a nursing home.
Correct.
So I want to kind of geriatric my house, right? I want to make that thing ready for a senior lifestyle, and I want to do that now. So I'm buying a single home, a single level home.
Right.
And if I have stairs out, I might want to change them into ramps. We're already starting to see this kind of new mentality, and maybe you get your grandchildren to get certified as visiting angels for support if you want inside the family idea. But here's this, I may never use this money for that, but the odds are high right now, 70% of all seniors use some form, not all, maybe they're not totally into convalescence, maybe they're not totally into a nursing home with a private room, but most people are having some form of assisted living, some kind of, and I want to do mine at home.
Correct.
So
and
this
another
could be
note
huge.
on that is, of that 70% that are going to require it, 4% actually have it covered.
Wow, that's scary.
That is scary.
So if I'm entering into my senior years and everything else, I got everything set up, my house, everything else, you say, Steve, I really don't see HECM for me. This may be the way to go. Having a financial reserve account. This is your backstop of backstops. And I ran into this. I have most of my, I'm thinking about the long-term care I have. My benefit's about $450,000 total accumulation. If you had a home that was $636,000, you might be at $300-something thousand.
Correct.
And you didn't pay any premiums for
Correct.
it. I mean, see, this is what I'm saying. These are the kind of things that we need to look at in the big picture. So I could use this, and I want to ask you about this because this comes up a lot. I noticed that some people say, hey, listen, I just met this guy, I'm 79. I'm thinking about getting the HECM line of credit to go ahead and fix my home for senior living. I'm at that point now where I'm thinking, can I go ahead and take out some of my appreciation line of credit and go say, I want to do this?
You sure can. That's what it's designed for. It's designed to take it and use it when you need it. That's a great idea for people who don't want to go into an assisted living facility, who want to keep their home, their dream home, if you will, to turn it into an assisted living facility in such that they have ramps, they have maybe handlebars or bars up the stairs,
in the shower,
and those that's what it's for.
Hey, I'm looking at, I see these ads for walk-in bathtubs all the time. And I'm thinking, hey, that'd be my first move,
Correct.
right? And you want to be able to start, so you can start thinking, how am I going to afford this? Well, we just said, the appreciating equity line of credit, as long as you're 62 or older, it's your prime residence. This could be a way to solve some of these issues.
And you may not need it, so the earlier the better on the appreciating line. At 62, a lot of economists are saying at 62 get the home equity conversion because at 68 or 70 where you may need it, it's increased in value.
You may only have to take the earnings on
Correct.
that and not even touch the principal.
That's correct.
Okay, I'm all over this idea because this to me makes sense. You are paying, and just to be full disclosure, you are paying a cost up front.
Yes.
You're opening a line of credit. It's just like a mortgage.
Correct.
Really.
Correct.
You're going to be paying some closing costs here.
Correct.
That may or may not, depends upon who you are, it seems steep to you. But to me, to have it and have an insurance policy, kind of insurance money, I should say, in the background, that I could use and tap into at any time for these emergencies. Again, I'm trying to use it as such. I'm not going to go to Europe and go on a world tour or whatever. I'm trying to be reasonable and rational and practical. So I'm using this money for those things, especially long-term care. Interesting, next to taxation during your retirement, your number one issue is going to be long-term care and medical costs.
That's correct.
Those are your costs. And where are you going to pick that money up? Medicare will take care of some of this, but they don't. But Medicare doesn't take care of really long-term care. It has a short provision in it, but it's not a long-term care. This could be the way to go. And if you're like most boomers, like I am, I do not want to go to an institution. I want to do it at home. Correct. I want to prep my home. So I want to make sure I heard you right. I can use this. Well, actually, I can use this money for anything I want.
Anything you want.
I highly recommend that you use it to set your house up for senior living. Be prepared, get it all ready to go.
Yep.
When you start feeling, hey, you got aches, you're not as spry as you used to be, this could be the time to do it.
That's correct.
And I would be setting up my home. Now, how many people, have you had people that have taken this line of credit just because of what you said? I'm just taking it just to take it and set myself up.
I've had clients that have no intention of touching this money. They have no intention. I've had clients that have taken and have done repairs to the home, to the sense of a senior living, if you will, and a majority of the people who do the home equity conversion, the line of credit, don't use the money. They don't have it earmarked for anything, but they know it's there if they need it.
I like flexibility. I like having a backstop in case the ball rolls between my legs and I need to go get something.
Correct.
I like the ability also that I don't have to pay it back. Now let's go just touch this on our way out of the segment. I used it, and you're not charging me. You're charging interest, but you're not charging it to me.
Correct.
I don't have to pay this back.
Correct.
As long as I'm living there for the rest of my life, myself, and if my wife's on the loan as well, we don't have to pay any of this.
Correct. Back. And keep in mind, if you do already have a mortgage on the home, this would remove that mortgage. So let's say you had a $50,000 mortgage on the house, and your house is worth $300,000, and your home equity your assist or your appreciating line of credit is $80,000 to $90,000, you are done making mortgage payments forever.
So even if you had a mortgage, this may be able to swallow up your existing mortgage and still give you a line of credit and no payment.
No payments. Correct.
Wow. I did not know you could do the combo on the appreciating line of credit. Huge, Eric. I want to thank you for being on our show and sharing all these cool ideas on home equity solutions in retirement. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counselor, or financial advisor. You've been watching Steve Savant's Money, the name of the game.